In an industry marked by distress and dislike, where commodities and sectors become the most hated, it lies the perfect opportunity. But how do we recognize it? How we can differentiate between the mere distress, the deep dislike, and the three ugly? Today, for first time, Rick will join us to discuss about the good, the bad, and the ugly in the mining sector.
Welcome, mining lovers. This is Charlando de Minas, the Spanish podcast dedicated to mining investment. Now, in English. Do you want to learn? Subscribe. Do you want more content in English? Leave us a comment. The episode is about to start.
Welcome to Charlando de Minas, the Spanish podcast dedicated to mining and commodity investment. Today, it's a special day, the kind that I dreamed when I first launched this podcast. We are joined by a well-known guest for his deep knowledge in the mining sector, a figure who needs no introduction, really. We speak with the one and only Rick Rule. Hello, Rick. How are you?
Bienvenidos. I'm delighted to be with you. You've exhausted my Spanish.
Before we dive in, for those who anticipate this episode to be in Spanish, rest assured that we will be Rick Rule speaking in the language of Cervantes shortly. Just don't forget to check out our next episode where we dub this interview. Then, Rick, let's begin. We'll have a first set of questions where we will be talking about investment strategy and maybe a little bit of macro. Then we'll have a second set of questions that, if it's possible, we'll ask you to provide shorter answers because it will be a much more focused questions. You often mention that mining is a capital-intensive business where you are either a contrarian or a victim. You have highlighted this necessity of investing in commodities that are essential for humanity or that will be used for at least 5 or 10 years ahead, but they are yet so undervalued that the median production cost undercuts the selling price. If we take uranium, for instance, a few years back, the spot price was around $20 per pound, yet it cost 60 to produce, leading to your quote that either a price had to rise or the lights will go out. This scenario typifies an industry in distress, industry in destruction, probably bottom of a cycle. In your opinion, there are any other commodities that you see in a similar state of distress?
Indeed. I think they'll become more distressed, but let's talk about them. Sulfide nickel deposits. Because of the explosion of low-cost lateritic nickel in Indonesia in particular, but also the Philippines, the sulfide nickel business on a global basis, with the probable exception of Russia, is in liquidation. There is so much capital involved in the sulfide nickel business that the industry will continue to produce below the cost of production for a couple of years. It's called the last man standing contest. They don't want to shut in their minds because they want to be able to produce when the price turns around, and they have so much stranded capital that they produce below the cost of production. But now is the time to begin to learn about the sulfide nickel business, to build a shopping list. Sometime in 2026 or 2027, we will have experienced enough supply destruction in the nickel space that the prices will inevitably rise, much as they rose in the uranium space. A different commodity that exhibits, I would say, the same characteristics are platinum and palladium. The platinum and palladium markets in particular have been disrupted because the Russians have been selling. The Russians, for obvious reasons, need cash.
Of course.
They're selling whatever they have in inventory, which includes platinum and palladium. Interestingly, the narrative around platinum and palladium is poor because the popular belief is that the internal combustion engine, the carbon-fired engine, is going the way of the dodo, the dinosaur. My suspicion is that won't happen for 40 or 50 years. And platinum and palladium are an important part of auto catalysts, And so the
Yes.
demand for them will last much longer than other people believe. Again, they will continue low as long as the Russians still have inventory to sell. But ultimately, remember that platinum and palladium come mostly from three countries: South Africa with political and social challenges, Zimbabwe with worse challenges, and Russia, ironically, the most stable of the three, a country at war. Any disruption of production from either South Africa or Russia would have profound and immediate impacts on the platinum and palladium business. I'm attracted to the whole suite of agricultural minerals, particularly, of course, potash and phosphate. I believe that those industries, as a consequence of Russian dishoarding and an increase in productive capabilities in Morocco, are also marginal industries. But
Yes.
as more and more and more of us inhabit the earth, and as the poorest of the poor get wealthier and are able to increase the quality of the food that they consume, demand for agricultural minerals and materials, I think, will continue to rise. And then finally, of course, copper. Copper is a conundrum because the long established mines, the Chilean mines, the African mines, the Russian mines, a couple of the American mines, are profitable at today's selling price, but the price isn't high enough to incent enough new mine construction. The whole gamut of electrification in the world is going to see demand for copper increase, but we haven't for 30 years invested enough in copper supply. So we have a circumstance where, absent a global recession, which of course might occur, demand for copper will substantially exceed supply within 5 years. You will see, absent a global recession, higher copper prices. And this is the point in time where the far-sighted investor begins to invest across the spectrum in copper, depending on where his or her sweet spot is with regards to risk, time, and reward. I think finally, the best business in extractive industries by far is the oil and gas business, determinedly out of favor and also very cheap. The European community and Western governments, particularly the American and Canadian government, would have you believe that peak demand for fossil fuels occurs in 2030 or at latest 2032. That's just wrong. It's not going to happen. Around the world, people who don't have access to good transportation understand that the most efficient form of transportation is provided by fossil fuels. My suspicion is that fossil fuel demand, irrespective of the wishes of Greta Thunberg or Angela Merkel or Joe Biden, occurs in 2065 or so rather than 2032. So I think a portfolio, a contrarian portfolio that emphasizes oil and gas, coal, if you can stomach it, copper, agricultural metals, in the future, nickel and PGMs would be a contrarian portfolio. I think the sector that requires the least courage, because the narrative is becoming the clearest, are precious metals. Precious metal stocks are never cheap, but occasionally they represent fair value. And this is one of those times where they represent fair value, but where the price cycle is already in favor of the industry.
Yeah, we'll talk a little bit about precious metals later, but you said a bunch of commodities, no? However, the only that you said, maybe I didn't understand correctly, but that have a lower price of production, then it's a complete destruction nowadays, is nickel, right?
Understand that I'm talking about sulfide nickel.
Sulfide nickel.
The nickel laterites in Indonesia, oxide nickel deposits, are very economic, given the way that they're mined. The difficulty with that is that the environmental destruction, which is wrought by lateritic nickel production, is really ugly. I mean, I've personally flown over those mines. And my suspicion is that the Indonesian people are going to insist that the industry hold itself to higher environmental standards in Indonesia. If they do that, the costs of producing nickel in Indonesia will rise and equalize the market. Right now, the cost advantage of the nickel laterites relative to sulfide nickel production means that nickel mines are shutting down. Sulfide nickel mines are shutting down around the world, but particularly in Australia. So we're already seeing the supply destruction that always leads to a market rebound.
This is what I love to hear, really. Is this happening as well in potash? Because I don't control really the market of potash, and I really don't know which are the costs. And you mentioned potash in your bunch of commodities.
There is some state-supported potash production, as an example, in Belarus, which isn't economic at today's prices. Okay. The Russians and the Kazakhs are the most efficient potash producers in the world. And again, the potash market has sold off as a consequence of Russian oversupply, which strains the economics.
Make money.
Strains the economics of Canadian potash. Other potash around the world, including in Spain, is not in the lowest cost quartile and is really, really, truly threatened. Two things are happening. The mines that are being depleted, particularly in Belarus, aren't being replaced by production elsewhere. So production or production capabilities are falling. The Russians in particular are not making the sustaining capital investments in Russian potash because they have other uses for the cash.
Yeah.
And looking forward, with 8 billion of us on Earth, all of whom like to eat, demand for potash is very, very, very well assured. It's an extremely efficient nutrient, whether or not Greta Thunberg or somebody thinks we ought to be using it.
Perfect. You have expressed it as well a strategy of investing in commodities that are not only undervalued, but are also broadly disliked. No? Yeah. Silver comes to my mind. It's not necessarily an industry distress because it's mostly produced as a byproduct of gold and copper and so, but it's certainly not a crown favorite. How do you approach to invest in such commodities? When do you know when it's the time to invest?
The truth is that you don't. I'm invariably early. If I see a commodity that's broadly hated, an industry in distress, an industry where even the best companies in the sector can't raise money when they need it, I like it, particularly if I can understand why the investor hostility to it is so strong. In the case of silver, if you dial yourself back 4 years, you may remember a sort of an online craze around silver, the sort of Reddit silver squeeze.
Yeah, silver squeeze. Yeah.
There was a narrative around silver which was simply untrue. And a whole bunch of people got caught up in the narrative and bought silver. And they were all rewarded with 30 to 50% losses. They're all angry. I don't know how well this translates, but there's no hate that's as severe as the hate of a jilted lover. And in the case of a whole bunch of people around silver, there's a bunch of jilted lovers. We move forward now to the point in time where a move in the silver price is much more proximal, much closer. And the people who hate it haven't kept up with the narrative. In my experience, precious metals bull markets are led by gold because the buyer is a fear buyer. When the narrative around precious metals establishes itself, both for the precious metals investor, but more appropriately for the generalist investor, silver, probably because of its lower unit price, moves further and it moves faster. Gold has already established that momentum. It's broken out to at least nominal highs against every major currency in the world, including the US dollar. And just in the last 10 or 12 days, silver has started to move for the reasons that we would expect. But right now, outside the silver community, mercifully, no one cares.
True, true. Um, your portfolio diversification intrigues many. No, despite owning various commodities, listeners often presume that you own a significant portion of any commodity that you mention in any program, like the one that we're having. No, then the question probably is, when you name a commodity that you like, for example, silver, really how much this usually represents of your portfolio?
Silver is speculative. When I was a younger man, I
Mm,
was more interested in speculation. I
mm,
needed, frankly, to make a fair amount of money, and I did. So for me, the speculative part of my portfolio is much less important than it used to be. I own silver stocks for one of two reasons. A, because I believe that the silver stocks will do well, but B,
mm,
because some of them uh, are such efficient generators of cash that you would own them irrespective of what they produce. In direct
mm.
answer to the question, only about 2% or 2.5% now of my portfolio is involved in silver specific
Okay.
um, allocations.
Then Hmm. No, is this just general for the audience? When someone like you, someone with your experience, and you say, yeah, silver is hated, silver is speculative, silver can be the next mover. You justify all of this, but you only hold 2.5% of your
You
portfolio.
know,
Then people need to have this in mind.
understand, I'm old and fat and rich, and I don't think that my portfolio allocation should be an indicator for other people.
No.
I sort of believe, I'm not saying it's true,
Mm,
but younger listeners need to familiarize themselves with the price volatility of silver stocks in past markets.
mm,
I believe it is possible that 2.5% of my portfolio would grow organically to
of
25%
course.
of my portfolio. I remember very well in the decade of the 70s, Coeur d'Alene mines going from 10 cents a share to $65 a share. Sadly, I was too young and poor to participate. I remember very well, however, in the early part of the decade of the 90s, both Pan American Silver and Silver Standard going from 50 cents and 72 cents, respectively, to $45 in
Mm,
7 years. You invest an amount of money in speculative silver stocks that you can afford to lose at least half of, with the expectation of owning them for 5 to 6 years. What is amazing about the silver stocks is that if you've chosen well and if you've timed the market well, tenfold returns, 15-fold returns, or better are possible. So a small allocation, one where the risk is within your range of tolerance, can generate what are, for many people, they were for me, life changing returns.
of course. Of course. Reflecting now on copper, you mentioned a couple of years ago that when copper hit $3, the easy money have been made. Yet, with copper prices fluctuating and recently surpassing $4, there must have been opportunities for easy money again. How do you identify these easy money moments?
The copper space is a space that a mining investor must be in most of the time. Uh, Copper is the nearest of the mined commodities, along with iron, to oil and gas, which is to say it's absolutely critical for the future of humankind. And the copper price isn't high enough to incent the production that we're going to need 5 years from now.
Hmm,
So, uh, an investment portfolio, a resource investment portfolio, not a speculative portfolio, must include copper. You need to focus on the low cost producers with very long lived reserves. So you need to own names like Rio, of course, originally from Spain,
of
BHP,
course.
Glencore, And you need to understand that you're likely to own these stocks for 10 years. If you see a circumstance where copper is on the headline of every major newspaper in the world because the price shot up a bunch, then of course you sell some stock. When everybody's clamoring to buy some, you reduce your holdings and look for something else that's hated. But you're never really truly out of the copper business. Meanwhile, because mining stocks are out of favor, and because the cost of capital for mining is fairly high, there are unusual opportunities, I think, around very large copper deposits that will be built strategically. My my discussion with you before we went on the air tells me that you've alerted your subscribers, as an example, to what's happening in Argentina, in the Vicuña district. What you're seeing there is the emergence of a very, very important copper province. It's going to take a long time. It's going to take a lot of money. I've been there. It's truly in the middle of nowhere. But you have a copper endowment there that is important in a global context. You need to think of that copper district in the context of the huge copper porphyries in Chile, which have generated wealth for Chileans for 150 years. You need to think of them, although they aren't of the same type of origin, you need to think of them in the same terms as the Rio Tinto belt, the Iberian copper belt in Spain and Portugal. So that's important. And I think that what you need to look for in the copper business is size. Size and grade. Specifically, I don't know how well this will translate, but you need to focus on deposits where at least the target size, the reasonable target size, is 10 billion US dollars in recoverable in situ reserves and resources, where, as supported by various documentation, we can talk about documentation some other time, where the deposit will be in the lowest cost quartile in terms of all-in sustaining costs worldwide, and also where the deposit will be, or you hope it will be, in the best quartile worldwide in terms of return on capital employed. But at current copper prices, the return on capital employed, even the prospective return on capital employed, has to exceed 25%. If you follow those guidelines year in, year out in the copper business, you'll make an awful lot of money. There are a lot of copper mines in the world that generate pre-tax €1 million in profit a day. These and some of these things have 15 or 20-year reserve lives. These are really, truly annuities. Things can go wrong politically. Things can go wrong socially. But if you construct a portfolio around legacy deposits, long-lived deposits that generate 25% plus return on capital employed and are in the lowest cost quartile on a global basis, you will do very, very well in your life.
Perfect. A little bit regarding these opportunities and when the easy money have been made. You said that you sell a little bit when you see all the highlights on the news and so on. But how do you determine the right time to sell apart from, it's everywhere in all the highlights? Do you rely on NAP? I know that you said, I always sell too early. And I know this answer. But when do you decide to sell? It's for calculation, it's for NAP, or it's just waiting to become more attractive to the main audience?
Well, first of all, I never get it right, ever. And I think that, I think any anticipation that you're actually going to get it right is foolish. When interest in the commodity gets very high, when the narrative in mining circles and in the general investment circles becomes positive, I begin to sell. When I mean you're beginning
Okay, but you begin to sell. But you have a bunch
Yep,
of different
yep.
miners there. Then you have to decide which ones will you sell. Then between one and another, how do you decide which one?
I sell my speculative portfolio first. I sell the
Okay,
stuff that's the riskiest, and I try not to sell all. I try to get myself to a place called the point of no concern. The point of no concern is where
okay,
you've sold enough stock that you have no net investment in the rest of your position.
yeah,
Yeah,
it goes
it goes
free.
free. In some of my positions in mining, as an example, Rio, Glencore, BHP, uh, I have core positions which I'm unlikely ever to sell. I sell puts and calls against them, which is to say, if I think that Rio, as an example, is attractively priced, on maybe a quarter of my position, I'll sell below market puts, giving other investors the ability to sell to me if the price goes down, and I'll sell above market calls, giving other investors the right to buy my stock at a fixed price going forward. The idea that the market will pay me to buy low and sell high, which is to say, do something that I would otherwise do for free, is attractive to me. And there are occasions
Mhm.
when a commodity is really hot, where as much as a quarter of my position will be called away from me because I've sold calls. That happened in my Cameco position in uranium. I didn't go to sell Cameco, but I had written covered calls, and my position was called away. I didn't feel too bad because it was a triple, you know. But in my core positions, in my investment grade positions, I'm inclined to hold those for the very, very long term. If
Okay,
we were to see
okay.
the copper price go to, you know, 10,000 euros a ton, as an example, and
Mm.
we were to see the cost of capital go very, very, very low, and if you were to see positive remarks about copper in all of the major investment media in the world, I'd carefully consider selling a bunch of my copper stocks, particularly if some other commodity that I was familiar with became cheap. If I could take the money that I had invested in copper producers and put that money, as an example, if they were cheap, in iron producers or oil producers,
Hmm.
I would probably make that trade. But we're not close. We aren't close to
Of course.
10,000 euros a
Then
ton.
then what you are saying basically is that you have a core of the commodities that you like in long term, something that you will hold at least 5, 6, 10 years, and then you have a bunch of speculative junior miner movers that this is when you say easy money have been made. I sold my stock. You said that these juniors is the one that you
Absolutely.
sold. Perfect. Understood. Understood. Because sometimes people can, believe, oh, Rick Rule have sell it all. What I am doing
Well, listen,
inside?
if something goes wrong, I sell
Yeah,
irrespective of price. If I
of course.
if I own a company, a speculative company, because I think there's some exploration outcome, and it turns out that I was wrong. If the
Hmm.
exploration results weren't what I had anticipated, I will sell, and I'll sell without
Yeah,
regard to price. If
yeah. It's something that we sell a lot of time to the audience. That you make a thesis. You invest for something. If you invest for exploration, this means there have to be this exploration thesis. If this doesn't work, if all the drillings become with nothing or not what you expected, then you have to make a decision. And if the decision is that you were only there to having this right, then you have to sell. There is nothing wrong on there. You will miss something and you
this
will
is
win
the
others.
single most important facet of exploration speculation, what you just said. People regard the exploration as an asset intensive business. It's a knowledge business. You develop a thesis around a property and you test that thesis. Understanding the thesis, ground truthing the thesis, and then fairly carefully monitoring the process by which the thesis is tested, and having your investment decision governed by reality is critical. That's the whole
By
game.
numbers.
Everything else is silliness.
True. Let's talk a little bit about gold now. Gold, we see an increase of price over 25% in the recent months, or probably weeks, partially due or mostly due because China and the BRICS are buying all that they can. When there is a reserve commodity surge like that, it often suggests that there is an underlying issue that we might not be fully aware of, because we think, why right now and not a couple of months ago, no? Or why they don't do it in a slower way that they will not increase in such a rate the price. What are your thoughts about this?
First of all, there have been other parts of the economy, other parts of capital markets that have attracted more attention. When people were saying to me 2 years ago, Rick, when is the gold price going to move? My answer was the year 2000. In US dollar terms, gold was $256 or something like that, an ounce in 2000. And by 2010, it was 1,900 US dollars. In the period 2000 to 2024, the gold price again, $256 to 1,900 US dollars. In other words, an 8.6, 8.7% compound internal rate of return. Gold kept up with inflation. It did exactly what the investor wants it to do. But because the moves weren't as dramatic as the moves in the decade 2000 to 2010, or in the decade 1970 to 1980, investors thought that gold was underperforming. The problem wasn't gold. The problem was the perspective of the investors. Now, we have a situation where the gold is moving up much more dramatically in price. That's occurring, I would suggest to you, for three reasons. The first is that fiat currencies around the world, including the US dollar, are declining in terms of purchasing power, which is to say, while we have nominal price increases in gold, the real price increases in gold are less dramatic. It's like an arithmetic, contrasting the numerator and the denominator, you know. The second thing is that for 50 years, the world's reserve currency has been the US dollar. And the deepest securities market in the world is the US Treasury market. Countries around the world have settled their trade with each other, not just with the US, in dollars. Even in the euro community, the second strongest currency in the world, the medium of exchange country to country, often within the euro community, has been in dollars, but certainly around the world. And nations have stored their wealth in US treasuries because the liquidity and the transparency of the market is unlike any other market in the world. But the hegemony of the US dollar has begun to be much less complete. The reason for that, I would suggest, is that the US government has attempted to impose its will extraterritorially on other countries through the mechanism of the dollar. Irrespective of what you think about the Russian adventure in the Ukraine, the US government decided that they would, in effect, steal $300 billion in Russian treasury holdings, which was a lesson not just to Russia, but to other regimes that believe that the US government might not hold them in high regard. The Chinese, the Indians, the Iranians. And at the same time, the United States, in effect, weaponized the SWIFT banking system worldwide. The SWIFT banking system is an international organization. It's not a U.S. organization. But the U.S., that notwithstanding, basically decided to use the SWIFT banking system to impose its will extraterritorially on central banks around the world. And then finally, the period of declining real interest rates that existed over the last 40 years that made U.S. Treasury securities such good investments has turned around. The treasuries themselves, irrespective of the weaponization of the US dollar, are less attractive investments to foreign central banks than they used to be. The consequence of that is that foreign central banks for the last 3 years have been very aggressive purchasers of gold. They've been steady purchasers before that. But the central banks require a medium of exchange so that they can deal with each other outside of the dollar. This is not, by the way, the BRICS currency. the BRICS currency would involve a fiat instrument that was backed by many bankrupt governments. As little as the Russians or the Chinese or the Indians trust the US, they trust us more than they trust each other. The worst thing that the Chinese could do would be to have several trillion rubles built up as a trade surplus with nothing to spend it on. The consequence of that is that foreign central banks have been consistent buyers of gold. What's important to note is that this increase in the gold prices happened without the participation of a retail audience. Until 15 days ago, in both the EU and in North America, physical gold ETFs have experienced net selling, which is to say that individual investors, the traditional strength of gold, have been net sellers for 3 years while central banks have been net buyers. I think you're going to see a circumstance where the perception among individual investors that they are losing purchasing power in savings instruments denominated in US dollars or in euros will cause a widespread popular uptake of gold and silver on top of continued central bank buying. If that happens, and I'm not saying it will, but I think it will, if that happens, I think that the move in the gold and silver price, irrespective of the currency that you measure it in, dollars or euros, will become much more dramatic.
Let's hope
Well,
to
be
see
very
it.
careful what
Let's
you
hope
wish
to see it.
for.
Yeah, I know that if this happens, this means that we are in a terrible
Be very
situation.
careful.
I know. But let's say in that way, I take it back and I say, let's hope for a big move on gold and silver without any hard
Yeah,
time. Let's
I
say
don't
it
I
in
don't
that
think
way.
that's an option. I think that you need to prepare your portfolio for the possibility of hard times. I think people who
No,
don't
of
own
course.
physical gold and people who are cognitive, people who think, who don't own either investment quality gold stocks or investment and speculative quality gold and silver stocks are making a mistake. I'm not saying it's an absolute certainty that they're going to make a killing. What I think is if you don't own physical gold, you don't have any knowledge of economics. And if you think that the gold price is more likely than not to go up, gold stocks relative to the gold price in historic senses are very cheap and probably good investments.
Yeah. Perfect. Now we will start with these quick questions that, in the measure of possible, to provide short answer. I know that for you, Rick, will be complicated. I mean, I don't have a restriction of time really, but it's more for you. And we will start a little bit with gold and the price of the gold miners. No, you said that they are relatively cheap, and gold miners seems to be gaining momentum on the last weeks. Despite the historical challenge of the sector in delivering shareholder returns. No, I came across with a post in social media that the top 6 gold miners free cash flow per ounce in when the gold was 1900 was only $127 per ounce, compared with in $1,400 was $150 per ounce. This means that there is really no change with over $600 increase. Although these numbers and the capacity of gold miners to lock in this return to shareholders, most of the gold miners have rallied 50% over the last few weeks. Is this just because last-minute investors are trying to jump in, or something
I don't
has
think things
changed
have
now?
changed. I think that the more rapid increase in the gold price that you're going to see is going to begin to increase margins. What the gold industry perhaps doesn't want to acknowledge is that although the gold price has increased well over the last 2 years, all of the inputs involved in producing gold have increased too. Labor costs have increased, energy costs have tripled, steel is up 40%, cement is up 50%. But most importantly, social rents, the cost of government, offsite expenditures, tax,
Yeah.
royalties have been increasing at 20% compounded per annum. When the price of something increases, but the cost of producing it increases as fast or faster, the headline increase that you see in revenues isn't matched, as you've proven through your work, in margin. Some of the anticipation around the gold equities is a function, I think, of the fact that people believe that the increases in gold prices that you've seen in the last 4 months or 5 months, but particularly in the last month, are going to accelerate. It wouldn't surprise me if we had a pause. I'm not saying we will, but it wouldn't surprise me if we had a pause. I am one who believes that the gold price is going not merely higher, but much higher in nominal senses. And if
Yes.
that's right, the companies that have some ability to control their on-site costs and their G&A will do well. Understand that governments will continue to rape mining companies. Mining companies are, not particularly popular with the voters, so that'll
No.
continue to happen.
Okay. In these bull runs, like the one that we are showing now in gold, and that probably will follow if the interest rates don't increase. Some, let's say, shitco juniors, companies with very high all-inclusive sustaining costs, high debt, high leverage to gold, behaves really well because become from losing money to winning some. Then, what is your opinion about this kind of investment
That
in
was a
this
wonderful
case?
technique in the 1990s, early 1990s, when nobody believed the gold price was ever going to go anywhere. And you could buy the marginal companies, or you could buy deposits that weren't economic really, really cheaply. That thesis worked so well that investors now and speculators, institutional investors, are looking for optionality. And ironically, they buy up the shares of these lousy companies to the extent that the market capitalization of some of them doesn't leave much room for price appreciation. I remember, being part of building a couple of these companies. Seabridge comes to mind. We were able to buy 3 or 4 million ounce deposits that wouldn't make any money at all at $300 gold, but would do okay at $1,000 gold. We were able to buy those deposits for $3 or $4 million each after they'd had $100 or $150 million spent on them. In the decade 2000 to 2010, when the gold price went from $256 to $1,900, those companies did fictionally well. The consequence of the market having learned that lesson is that people are paying too much money now for marginal deposits.
Okay.
So the cover charge, the market capitalizations are too high.
Then, which numbers do you like to see if you will invest in something like that? Which should be the, let's say, the market share, the market cap for each million of ounces of gold or something like that? How do we spot
Sadly, there's no
these
rule
the
of thumb.
opportunities?
When people use market cap per ounce,
Okay.
they're talking about narrative. The net present value calculation, if you try and use a rule of thumb, doesn't take into account the capital cost to bring that into production on a per ounce basis, when the ounce will be sold, so the net present value, or the margin. There are institutional investors who use that metric because it's an easy to discuss rule of thumb, and investors like it. But aside from the fact that investors like it, it's meaningless. Making money in natural resources is all about enterprise value relative to risk-adjusted net present value. And sadly, you have to do a whole bunch of work to get that number.
Yes. Yeah. Now, the next question, it's a very good question. Just saying that you said a lot of work that you have to do to invest or to get that number. No? Regarding investment strategies, there is the Lobo Tigres pre-production sweet spot. No, that it's often a simple yet effective method for investing in the mining sector. Do you consider this a viable strategy for those who not have the time to dedicate to extensive research like you, or that wants to have a life apart from
Speculators
investing?
who are willing to lose some money if something goes wrong in construction and who are patient can do extremely well with this strategy. What Lobo Tigre has done is found a part of the market that is unpopular, but is de-risked. The sexy news has already taken place. The exploration, discovery, all that kind of stuff has already taken place. The news releases now aren't grams per ton. They're the cost of cement, permitting. This is deeply boring and highly profitable stuff. For a speculator, this is a really, truly great strategy. And it's an enduring strategy because people speculate around narrative. They speculate around how they feel, not around arithmetic. And this is a strategy that goes to what Lobo Tigre is. You know, he's a physicist, really. He's a mathematician. I think it's a brilliant strategy. By the way, he's a wonderful guy. I don't know if you've interviewed him, but
Yeah, we interview a couple of times, and he will coming back again.
Unlike
before
his old
summer.
gringo friend, you can interview Lobo in Spanish.
In Spanish, of course. Perfect. Next question. A coup of state by military groups in Africa, it's something very common. Okay, and most of the time there are a massive selling of mining stocks that there are in the country. Do you see those sell-off as an opportunity for buying cheap?
On the subject of political risk, all jurisdictions are risky. I personally would rather try to build a copper mine in Zambia or Congo than in Spain or California.
States.
So political risk needs to be taken into context. If you play that game, you need to be willing on occasion to lose all of the money that you had invested in the sector. I invested in Afghanistan as an example 20 years ago, and I lost all the money. Russia treated me very well for 22 years until it didn't. What's happening now in Mali and Niger, I think, is instructive. The Malians, the Nigerians are really reacting to the vestiges of French colonialism and revisiting how they're going to deal with the outside world. We need to pay attention to that. But it doesn't necessarily constitute bad news. It may constitute bad news. But the fact that you have regime change and uranium deposits, as an example, get sold off by 70%, it doesn't change the value of uranium. You need to decide in the new fiscal regime what type of political certainty you're going to enjoy, what sort of social rents you have to pay, but you have to do it as agnostically as you can.
Perfect. You have noted in a previous interview with another podcast the importance of selling to passive investors or to passive money. Does this imply that by the time that a commodity or a stock is discussed publicly by famous actors in the sector like you, it's too late for individual investors to jump in those stocks?
What I'm talking about in terms of selling to passive investors is the progression in speculative companies from having most of the volume occur as a consequence of interaction between individuals and having those markets become institutional, or better yet, indexed. So when a company, as an example, in Canada achieves a certain market cap, let's call it $1 billion, all of a sudden that company begins to be included in indexes. And the index funds, the passive investors, have to buy it. That's a wonderful transition.
Yes, and a big mover for some stock. Okay, Rick, just follow. In another podcast interview, you said that you are buying now prospect generators. And I think that we will publish this interview after you host the Prospect Generator Bootcamp. For some people like me that we have never invested in prospect generator, but we are looking a little bit at these companies, would you like to give some advice and what the things we should look,
Absolutely.
what the
Thank you
things
for
you
the
suggest
opportunity.
that we should focus
A
on?
prospect generator acknowledges that the exploration process is really a technologically driven process as opposed to a property driven process. A little background statistical. When I went to university many years ago, I was taught in economic geology that 1 in 3,000 mineralized anomalies becomes a mine, which is to say that, well, the payment for success is high, the probability of success is very low.
Mm-hmm.
What you find is that there are some people who, as a consequence of their application of technology, are serially successful mine finders, while many people aren't. But it's an intellectual rather than a physical process. What a prospect generator does is apply their specific technical expertise and or their business acumen in a certain jurisdiction to do district scale exploration, develop an exploration thesis around multiple tracts of land, and then bring in joint venture partners who spend the physical capital to keep the intellectual capital of the prospect generator company. The prospect generator ends up with a carried interest, either a working interest, a minority working interest, or a royalty with very low capital expenditure. The idea of investing in prospect generators is that rather than investing in one property where the probability of success is low, that you invest in a portfolio of 30 or 40 carried interests in properties where the third party takes the risk. And by the way, the third party contributes additional intellectual capital for free. The real strength of this model became apparent to me about 30 years ago when we had joint ventured some properties, interestingly, to a company that you and I talked about offline, Freeport-McMoRan. And I went through Freeport-McMoRan's office and saw that Freeport-McMoRan employed about 225 earth science professionals. The prospect generator that I was invested in that had farmed out to Freeport-McMoRan only had 3 earth science professionals. And we got access to the 225 professionals in Freeport-McMoRan, and they paid us for the privilege. This warmed my heart. It was unlikely that there was going to be any technical challenge with regards to our properties that somebody at Freeport hadn't seen and addressed before. The second thing that warmed my heart is I came to understand that the due diligence that I had done, no matter how hard I tried, was going to be paltry compared to the due diligence that Freeport had done. If I went to hire a consulting geologist to look at this company's projects and report back to me, that geologist, he or she, that consultant, probably would have charged me in those days $3,000, $4,000, $5,000 for a survey. Freeport-McMoRan did a much more detailed survey, and rather than me sending them a check for $5,000, they sent us a check for $5 million. So not only did I get the access of their due diligence expertise, they paid me for the privilege of contributing it. That's the advantage. The statistical corroboration of this is that as I said at the outset of this discussion, and I'm sorry for the long-winded reply, the probability of success with a mineralized anomaly is 1 in 3,000. I have participated in about 70 public prospect generators. I'm sorry for the nebulous term about. I'm an old man. I don't recognize how many I've done, but about 70. And in 70 starts, I've generated 24 economic discoveries, I think verging on 25 now, and participated in 23 takeovers. So while the statistical average across junior stocks would be 1 in 3,000, my experience is more like 1 in 3. A couple standard deviations statistically, better probabilities. There is something about that arithmetic that I find absolutely addictive.
Yeah. Mother. Nice, nice. 1 in 3. Who? It's a very, very nice percentage. Okay, because this will be published after the bootcamp happen.
It
Will the
will. You
bootcamp be
can, in
available
fact,
online
subscribe to the
afterwards
boot
if
camp
anyone is
after the
interested?
fact. That's not a problem. It will be available in the Rule Classroom to subscribers for a year. By the way, whether if you attended
Perfect.
at the time of the boot camp rather than afterwards, we're going to give people much more information in 8 hours than they can absorb in 8 hours. Despite the fact that I put on the boot camps, I watched them myself an average of 4 times after I put them on, so that I myself can absorb all of the material from the other speakers at the boot camp. It's important to understand that this is not an entertainment function. This is an education function. And if you decide to come into the boot camp, it's because you are deeply and seriously interested in the topic. Otherwise, avoid it. This is not like you're watching, the funnies, the cartoons for 8 hours. This is real work.
Yeah. Perfect. Okay, let's move to uranium. My investment thesis on uranium market was it might be heading towards a bubble. No, this was a few years ago. However, the market seems to have stabilized after a significant rally. I have anticipated in the past that long-term contracts might start being signed at around $80, $85. Would this mean that the uranium skis
I
will
think
not be happening
I
this
think
time?
I need to say at the beginning
What do you think?
that the easy money in uranium has been made. And that's instructive for your audience. To make the easy money, they had to be here in 2022 when people hated the topic. The spot price, of course, is cleared from 20 to something like 95. Yeah. And that validation, the validation by price, has proved the narrative in people's minds. It's ironic that they warm up to something after the horse is already out of the starting gate. Having said that, there's a change in the structure of the uranium market. Yeah. And it's important for people to recognize because this has never happened in a commodity class before. The trades in the uranium market for the last 10 years have taken place mostly in the spot market, which means that both producers and consumers have no idea 18 months from now what price they are either going to receive for their uranium or they're going to pay to get uranium. More and more of the trades in the uranium market are going to the contract or term market, and this is critically important. This means that even a fairly small producer, if they have a bankable feasibility study, can go into the market and secure long-term offtake agreements with investment credit grade takers, which literally are collateral. You can literally take these contracts to the bank. It means that somebody that would have had to sell a deposit to build it will now be able to build it based on the fact that they have contracted to sell for 15 years enough material at a price that's well enough understood that the bank understands that the construction finance will be paid off by the material. This is critically different. What that means is that while the easy money has been made, the sure money is ahead of us. Now, your audience needs to know there are probably 80 uranium juniors in the world. But there are probably only 11 or 12 that are valid. And so you can't invest in the uranium sector. You have to invest in yourself to do the work, to segregate in movie terms between the good, the bad, and the ugly.
Yeah, yeah, and the ugly. Yeah, but this means basically that it's very complicated to see
I think
a
you may see a
uranium
uranium
bubble
bubble
like happened in the
because I
last bull
think that
market,
most
right?
investors uh, won't take the
Okay,
time to understand the dynamics of the uranium market. They will see some small companies that enjoy success
okay.
and go up tenfold in price, and they'll think that they went up in price because the uranium market is good. They won't have done the work to understand why these companies went up. The
Yeah.
uranium narrative will continue to be a great narrative. You will continue to see the utilization of uranium increase. You'll see Japan return the rest of its nuclear fleet to
Mm-hmm.
production. You will see new build and financing
Mm-hmm.
announcements taking place in China, taking place in Taiwan, taking place in Korea, even taking place in backward places like the United States. Uh, and so the narrative is going to be great. And the free cash flow that some of these companies are going to enjoy based on term contracts and the predictability of this free cash flow, which doesn't occur in any other commodity, is going to be spectacular. So you may see a bubble,
Mm-hmm.
but don't
Yeah.
buy based on the bubble, buy based on certainty.
Okay. Understood. You said that the current uranium market has changed, no? And then for this change, what do you prefer? A supplier of enrichment uranium field like Centrius Energy, or
Because
one of
I'm
these
not
good junior
competent
miners that
enough
you name?
to understand the competitive advantages of various enrichers and re-enrichers, and because I'm afraid that the
Okay.
new subsidiary of Cameco, Westinghouse, will be a very, very, very serious player.
Mm-hmm.
I'm afraid of the technology-based companies because of my own ignorance around all subjects other than exploration. I prefer to play, I prefer to stay within my own circle of competence. That's
Circle of
right. I mean,
competence.
I love what I think Centrus is doing, but I'm not smart enough to understand how they have a competitive advantage over Rosatom, the Russians, or over Hitachi, or
Oops.
over Westinghouse slash Cameco.
Mm-hmm.
I don't like betting on the minnow when the minnow is up against a shark.
Perfect. Perfect. Um, Lithium and rare earths are an industry
Well,
in
lithium is a
destruction
special
or are
case.
just a
The
hated
lithium price
commodity?
increased sixfold, which attracted all kinds of adherents who didn't understand the structure of the lithium
Mm-hmm.
market. Now that lithium has fallen in price by 75%, all of the former lovers are haters. You know from your own experience, there is no hatred as strong as the hatred
Yep.
of a jilted lover. And most of the people in the uranium space are jilted lovers. Interestingly, I think in 2 years or so, the lithium market comes back into balance. We were never short of lithium supply.
Okay.
What happened is that lithium demand exceeded the processing capabilities.
Mm-hmm.
We didn't have the ability to turn raw lithium into lithium chemicals fast enough to accommodate the growth in lithium ion batteries. But over the last 6 years, as a consequence of a sixfold increase in the lithium price, and as a consequence of the unlimited availability of capital, we have debottlenecked all of the bottlenecks that occurred. And as a consequence, the scarcity value went out and the price collapsed. Meanwhile,
Yeah.
the market didn't
Mm-hmm.
understand that we had no shortage of lithium. And so we went out and looked for it. Because we'd never looked for it before, we'd never found it. We found tons of lithium. And this lithium, I mean, we're going to have this really, truly ugly
Yeah.
Darwinian process where we go through 60 or 70 deposits that have been discovered in the last 10 years, and we narrow that down to 5 or 6 that are good
Mm-hmm.
enough that they can enter into a market that's already oversupplied. 2 years from now, investors are going to look at the lithium space and they are
Yeah.
going to hate it. They're going to hate it with the passion that they hated the uranium space in 2022. Ironically, when all of the data that is needed to figure out who's
Yeah.
going to make it and who isn't going to make it is available, nobody's going to care about the data. And I'm going to be on this like white on rice. Absolutely, positively like white on rice. Lithium is going to be like uranium. And what's going to happen in lithium is that the dynamic of the uranium market, which is to say long-term contracts that are in the benefit of both producers and consumers, will happen in the lithium space too. That will be the second market that will go from a spot market to a term market.
Mhm.
So in addition to everything else, in addition to the fact that the stocks will be hated and hence cheap, there will be a certainty around return on capital employed and margin in the lithium business that doesn't occur in any other business. But you're going to have to wait a couple years. You're going to have to be terrified first and then bored before before you become elated.
Perfect.
Yep.
No, I mean, 2 years it's enough
Uh,
time to study
I'm doing
slowly
that now.
every
I've
day a
actually
little bit
retained a consultant
and have time to invest.
be my tutor to take a 71-year-old man and teach this old dog at least one more trick. With, well,
Trick. And what about rare
both.
earth? Do you think that
Yeah,
it's
rare
destruction or is
earths
just hated?
ran in price because of geopolitical
Both.
concerns. First of all, rare earths aren't rare. Rare earths are very common. We
Mm.
haven't looked for them because the Chinese have been such efficient producers that we haven't needed to look for them. A couple things have changed there. Geopolitical concerns continue,
Mm.
but when the price went up enough to incent competition to Chinese supply, uh, the Chinese decided to wreck the market, which was very smart from their viewpoint. But the cat's out of the bag. When we began to look for rare earths, we found them.
Perfect.
And the Chinese have continued to make noises about using rare earths as geopolitical tools. The consequence of that is that fabricators of
Yeah.
materials requiring rare earths, primarily Korea, Japan, Taiwan, the United States, and to a lesser extent, the European Economic Community, are absolutely positively committed now to securing parallel supply chains. Having looked for rare earths for the last 10 years, interestingly, we found some. And what's happened as a consequence of the collapse in rare earth supplies, in rare earth prices, is that these successful efforts in exploration
Hmm.
have been wrecked in terms of price. This is a unique opportunity. There are a couple,
Hmm.
probably 5, rare earth deposits outside of China that are absolutely world class and competitive. One in Myanmar is likely to fall within the Chinese orbit, so it probably doesn't count. Uh, the other thing
Uh-huh.
that's happening is that costs associated with producing rare earths in China are rising very rapidly. The Chinese production methods of the last 30 years have wrought enormous environmental
Mm.
destruction in Western China, in Xinjiang. And the Chinese, including the Chinese government, are no longer willing to
Yes.
tolerate those practices. As China gets richer, its willingness to desecrate itself is declining. So at the same time that
Hmm.
the Chinese dominance in the rare earth space will begin to fade for geopolitical reasons, the costs associated with producing rare earths and the ability of the Chinese to undercut everybody else in terms of price is fading. Uh, Rare earths, from an economic point of view, are enormously difficult to understand. They are more than a topic. There are 60 or 70 topics, each of which in itself is a minor market ending in IUM.
Yeah. Yes, yes, yes. This is one of the things that it's a little bit complicated for me. Even I am chemist, and I understand a little bit the elements and so on and so on. But because all usually it is rare earth mining, they are mined all together, and there are different uses for each one. Then there is different market for each one. Then the complexity of the topic, it becomes much harder. It's not like lithium. You have the lithium, you have two different types of lithium,
And as
then
a
bam, bam, bam.
consequence of that, the
But
reward
with
for
the
getting
other
it right
one,
is much
it's
higher
much more complicated
because
topic.
there's not much competition. There are 300 or 400 people in the
Yeah,
world who regard
yeah.
themselves, correctly or not, as experts in the gold space. There are probably 5 or 6 true experts in the rare
Mm-hmm.
earth space. And you can, with a bit of effort, identify them. I've done that. And avail yourself of their expertise. And their expertise, because the supply is so
Okay.
constrained, is real. That's extremely helpful. There isn't much noise about it. It isn't a big enough sector that it's attracted the big investment banks because there's not a big enough industry to have enough fees to cause the big investment banks to be in the space. But again, the certainty associated with a tier one rare earths deposit, the scarcity of those, and the absolute necessity of fabricators outside China to have access to these materials means that if you align yourself with a tier one deposit, although it may take 10 years to finance it and to get the process technology right, the metallurgy right, to produce the product, the highly specialized product that's required to service the end user's needs, you will find a couple of these deposits that will ascend to $10 billion net present values.
Perfect. Very interesting. Okay, what do you think about this
Depends on their
phrase?
time
People
frame.
will regret to don't
I
buy
consider
at this price
Franco-Nevada to be
Franco-Nevada.
the highest quality gold mining company in the world. Note conflicts. I have owned Franco-Nevada on and off since 1982, since the initial public offering. The, the honorary chair of Franco-Nevada, Pierre Lassonde, is somebody who I have known and admired and liked personally, a personal friend, for 40 years. So, take some of my praise of the company as being personal as opposed to professional. But if you look at the statistics, the management expense ratio as a measure against cash flow is 11 basis points. That's stupid. The operating margins exceed 90%,
Yeah.
which is to say, effectively, their gross is their net. They have, for the most part, not exclusively, but for the most part, their value is from very large deposits. And this is important. All deposits yield surprises. Small deposits usually yield bad surprises. And big deposits usually yield good surprises. This is just virtuous. Is
Really
Franco-Nevada
big
cheap?
surprises.
No. Franco-Nevada is not cheap. But they have a couple durable competitive advantages. The market that you're going to see in the next 5 years for royalty and streaming is all going to be about providing capital around big transactions. It might be that countries, as an example, Ghana or Indonesia, want to increase their ownership in deposits but can't pay for them. There could be a circumstance where Franco-Nevada provides the capital to do that in return for a royalty and a stream in billion-dollar transactions. It could be that a big copper mining company needs to spend $10 billion to build a copper mine. And in order to finance that, they could sell a stream against the byproduct gold or silver production with that mine. Again, a $1 billion transaction. Exactly. The ability to transact
And
at
there is
that
not many
level is
companies
either
that can
Franco
have this
or
kind of
Wheaton or a
transaction.
club. And the club is going to be led by Franco or Wheaton. It's important to understand that when people look at Franco, they say, how can a company this size grow? I believe that Franco has the ability to double in 5 years, simply based on the financing needs of the industry and Franco's unique ability to write checks that large. I would say Franco and Wheaton, frankly. I would also say that both companies are uniquely well run.
Perfect. At current prices, for you, what is a better option to invest in the
That
Vicuña
depends on
district?
who you are. I
FILO,
suspect that
NGEX, or
FILO and
Lundin Mining?
NGEX ultimately will become part of Lundin Mining. I know the Lundin family quite well. I've done business with them since
Lundin.
1974. The current generation are the grandchildren of the people that I did business with. They are honest. Lucas Lundin, rest in peace, before he died, told me that every major deposit that they discovered that they sold was a mistake. Every single deposit that they sold, whether or not they made $1 billion, he believes was a mistake. And I believe that the district ultimately will be consolidated into Lundin Mining. It may be that the Lundins then will have to bring in BHP or Rio or somebody like that as a partner at the Vicuña level. If you want certainty, if you want to reduce risk, and if you're concerned about the time value of money, which is to say the Vicuña district may not be developed for 10 or 15 years, you buy Lundin Mining because you get a very generous dividend, which pays you while you wait. In other words, you get to have your cake and eat it too. If my thesis is correct, and if NGEX and FILO are both ultimately upstreamed into Lundin, then perhaps over time you will find that your return on capital employed is higher by taking the time value of money risk being associated with the two smaller companies. Now, I've decided not to be too fancy about it. Do I own Lundin Mining? Yes. Do I own NGEX? Yes. Do I own FILO? Yes. And I've owned them for a very, very, very long time.
Yeah, it's a very good strategy that I share too. I saw in a video that in the past you owned Integral Resources. A year ago, Integra Resources become Integral Resources Corp with the
Ask me
merge of
after my
Millennium Precious
conference.
Metals.
I'm going
What
to
do
have
you
a
think
deep
about the
dive
company now?
with Integra. I know the people quite well. I still have a fairly small shareholding there. What happened to me my first round with Integra is I got a pretty quick double. And the share price escalated faster than my certainty with regards to the deposit did.
Yeah.
To me, there were some unanswered questions, and I got my price target before my questions were answered. When the market rewards me in excess of the access to the information that I needed to justify the price, I sell, which I did. After that, they did this merger, and the price fell fairly precipitously. So I'm very inclined towards Integra, but I need to do a deep dive to have enough certainty to upsize my investment. And I haven't done that work yet.
Okay. Perfect. What do you like more to play the,
personally,
let's say,
gold.
gold, silver, go gold or New Pacific
But
Metals?
that's an interesting question. New Pacific has franchise advantages in Bolivia, And Bolivia is probably the least explored Spanish-speaking jurisdiction on the planet.
Mm-hmm.
It's a place where I've speculated both successfully and very unsuccessfully for 30 years. Uh, so the speculator, the hardcore speculator, would be drawn
Mm-hmm.
to Bolivia, both because of the size of the existing prize, but probably more importantly, because of the sensitivity with which the capital behind New Pacific, which is Chinese, has employed in Bolivia. I own Go
Mm-hmm.
Gold because I think that the if question has passed. I think we're in a when process now. I don't think you have a mine there. I think you have a district. And I think that they understand
Yeah,
the
yeah, yeah.
district well enough that their exploration is becoming predictive. In my experience, when your understanding of the mineralization becomes predictive, you reach a fulcrum point. You reach a point where you add ounces rapidly and cheaply. Your risk around Go Gold, I think, is the intentions of Senor AMLO with regards to the efficacy of mining in general in Mexico. I note that the mines minister now is the former environment
Mm-hmm.
minister. And that person would be, I think, described as politely
Yeah.
ambivalent towards mining. And I think that the constituency, at least the elite constituency
Mm-hmm.
that
Polite.
AMLO represents, are an academic leftist constituency that has other aspirations for the future of Mexico rather than mining. So I think that your risks associated with Go Gold are really political,
Yeah.
not social risks, by the way. I think Go Gold has done a very good job in the community. You know, formerly, uh, that was a subsistence agricultural community. And I think
Mm-hmm.
that Go Gold has provided the first access to cash employment in that district. And they've done a very good job doing things like drilling water wells. I think that their social expenditure, their local social expenditure, has been very good. But I think there is top line risk associated with the politics of Mexico with regards to mining. I think your audience might be able to teach me in that regard.
Perfect. Understood. Finally, last question. You are hosting the Rule Symposium in July. For investors around the world, what can
Well,
expect in
there's an
your
enormous
symposium that
difference.
they haven't seen in a
By the way,
VRIC or
I'm
a
a
PDAC, for
huge fan of
example?
PDAC. I've been going, I'm embarrassed to say, for 40 years, longer than maybe most of your audience has been on Earth. But my conference is very different.
Mm-hmm.
First of all, most mining conferences are free, which means
Probably.
that you, the attendees, are the product. If you don't recognize it, if it's free, you are the product. We charge attendees, which means that we hold ourselves to a much higher standard. How does that manifest itself? Well, firstly, the conference has stood the test of time. It's gone on for 30 years. We are not Johnny come lately. We get a little better every year. And if you get a little better after 30 years, you're pretty damn good.
Mm-hmm.
Why are we good? Paradigm, first of all. We have great big picture thinkers who tell you about the way the world is, not the way that governments or social media or popular media would want you to believe it is. We have the Jim Rickards, former CIA guy. We have Daniela DiMartino Booth uh, talking about the Fed because she was part of the Fed. Nomi Prinz talking about Wall Street
Mm-hmm.
because she was a Goldman Sachs analyst. We have big picture people who shape your view of the world in a very different way than you would get from mainstream media. After we've done that, we expose you to analysts who have been successful in natural resource investing for 20 or 30 years, not investment banking hacks that failed at technology, failed at consumer financial services, failed in 2 or 3 other industries before they were dropped down into mining. Importantly, we have a function that we call the living legends. where we will have 4 or 5 or 6 entrepreneurs who have built multi-billion-dollar companies from scratch, telling you how they did it, where they succeeded, where they failed, and more importantly, the lessons that they learned that make them better investors and can make you a better investor too. I had an attendee email me a couple of years ago saying the ability to follow Robert Friedland through the exhibit floor and see what companies he stopped to talk to and lurking on the questions that he asked was worth the price of admission all by itself, that everything else I gave him was free. And that brings us to the exhibitors. At every other conference I know, exhibitors are regarded as revenue.
Yeah.
They're regarded as advertisers. My attendees for 30 years have told me that my exhibitors are content too. So I have to hold my exhibitors to the same standards that I hold other content providers to. What that means is that I have to vet them. Specifically, there is no public company exhibitor at my conference that isn't owned in an account owned by myself or managed by myself. There is no guarantee, unfortunately, that every stock I buy goes up, but there is a guarantee that every single exhibitor there is vetted. The consequence of those factors allows me to make everybody an offer that isn't made by any other investment conference in the world. If you attend my conference either in person, which I would prefer, because there's a lot of nonverbal communication that occurs at a conference, or if that's inconvenient, if you attended online like 1,300 other people did last year, either one. If you don't think that the content that I have provided to you is worth the tuition that I've charged you, there's a gold-plated money-back guarantee. Nobody else does this. If you don't believe you got your money's worth, tell me that I failed, and I'll send you your money back. I would prefer if you told me how I failed, why I failed, what I could do to serve you better, but that's no requirement. If you don't believe you got your money's worth, I've been doing this for 30 years. If you don't believe you got your money's worth, I'll give you your money back. Now, I'm pleased to say in 30 years of money-back guarantees, I've had to return about 0.1% of the fees I've charged for educational products. That notwithstanding, if for any reason you don't think you got your money's worth, I'll give it back to you.
Understood. Perfect. Thank you very much, Rick. I think that we will finish with that. It has been a long interview that we touched a lot of different topics, and I am really pleased and really happy that we could have this conversation. I really enjoy it, and I hope that we can discuss a little bit more in the future and having you back on the show.
Going to enroll in Spanish immersion class with my wife. So hopefully in 2026, we will be able to have these conversations in Spanish. I think I told you I grew up speaking campesino Spanish in rural California, but that was many years ago. I look forward to be able to be at least haltingly competent in Spanish sometime before my demise. Great. Bye-bye.
I will be really pleased to do that, Rick. Bye.
Disclaimer. The content in Charlando de Minas is not an investment advice. Amadeu Bonet and his guests are not investment advisors. The authors may have interest in the companies mentioned in this publication. They may also have bias and not be impartial. The information in this publication and all the others in Charlando de Minas is impersonal by nature and should be considered as an entertainment product. The minimum risk of any investment mentioned in this video is 100% of the capital. Before to make any investment decision, contact to a financial or investment advisor or someone qualified with experience. These broadcasts are a narrative of my learnings in the world of commodities and mining investment. In this podcast, we will try to bring experts, professionals, and companies. If you like it, please subscribe. I am Amadeu Bonet. Welcome to Charlando de Minas.